Global debt has expanded to levels we have never seen before. To say they're extreme is truly an understatement. It's not just one or two countries that have high debt. In reality, it's all of them. So who exactly do the countries owe their debt to? Themselves? No. It's to central banks. You came here for the truth, so let me unveil that for you. Many people don't understand this concept of who the debt is owed to, but they need to understand where debt originates. That's your answer. Let's go on to this here, looking at $237 trillion worth of debt. It's almost an unrealistic number to think about. Whether we are looking at the non-financial corporates, government, financial corporates, or households, you can see what has happened over the years. Consistently increasing and increasing and increasing and burdening individuals, but also going all the way up to the nations and beyond. Debt is a burden, but the average person may not realize it. And a lot of people accumulate debt as if it was wealth. And there's a difference. There's a big distinction here. Some people use leverage to buy a piece of real estate, for example, and they're able to control 100% of a home with 20% actually put in there. And they can produce a profit, perhaps, rental income, and so on. The issue is that right now, today, we have historically low interest rates. And this has been able to cloud the judgment of many people. A lot of individuals have purchased homes with less than 20% down, less than 5% down, and they are willing to basically go in with the minimum they can. Now, they're leveraging. They're using debt. But is that wise? So there is, a line that you have to tread here. You have to watch it. I'm going to go into this more. We are looking here at the LIBOR. The LIBOR, I could show you this. I could show you the Fed funds rate, and it is essentially the same thing. The LIBOR was found to be a fixed rate. And by fixed, I don't mean that it was necessarily always the same thing. I mean fixed as in who gathered together and decided what the rates would be. And they were caught red-handed. What happened? Nothing. Slap on the wrist. Okay? So you will see what has happened here with the LIBOR rates, basically historically low for long periods of time, just like the Fed funds rate. Looking at the what the writing that they put here, essentially I just wanted to show you what happens as soon as these levels rise. Every single time, as soon as they rise, we have a market crisis. Many people that I've heard from countless times suggest that rates will stay low forever. Well, that's a possibility, definitely. But is it realistic? Not really. They have decided to increase rates at a very, very small fractional level. They have been, decreasing their balance sheet at a fractional level, if they want to call it that. But you're looking at this where maybe it'll take a while, but that's the direction they're going. They've never, somehow people believe that, they're not going to do it this time, or they'll work out a way so that the market will never crash ever again. Do you not think they had the same level of intelligence, the same level of skills that were around in 2007, 2008? Is this somehow different? Do they have special technology, or their, minds are working better? No. Okay, This is something that I've showed you recently, but wanted to show you again. Fed funds versus the LIBOR. Look at what the S&P 500 has done. Gone up to, new heights over these years since the financial crisis. But we've seen these two rates, the LIBOR and the Fed funds rate, inching up higher. As these rates go higher and higher and higher, even in small increments. Take a look at the LIBOR as an example. You have something, I forget this statistic now, somewhere between $200 and $350 trillion. Let's just say $300 trillion. If someone knows this statistic off their head, they can let me know. $300 trillion is interconnected with the LIBOR rates. Now, if those are inching up slowly but surely, we are affecting trillions of dollars all along the way. That's not good. That's very bad. I don't think I need to tell you that. And again, look, interest rates rise, the stock market crashes. Interest rates rise, stock market crashes. What's happening today? The beginning of interest rates rising. When you have $300 trillion in one particular interest rate, the LIBOR, this right here shows us what the potential is. Not a good potential, of course. I'm going to show you a series of charts right now, very quickly go through these. The Fed BS, that is named appropriately, definitely. Look at this so-called cutting back on the Fed balance sheet. You can barely see it if you look at it. But one of the other things I wanted to note here was the bank's excess reserves. These have declined much faster, $700 billion it looks like to me, in the same period of time where the Fed basically hasn't dropped anything off their balance sheets. With the Fed's monetary easing, they have done so with printing money out of thin air. And that's not real wealth. That's not real money. That's just printed up. And what do? Did they end up as excess reserves, or did they end up buying up garbage? That's what they did. That's very dangerous. That's very stupid. But of course, that's what they've done. Okay. Looking at the disposable personal income that you can see on the dotted line here. Okay. Fairly consistent. As time goes on, it's increasing. Okay. Look at the red line, the Wilshire 5000. Okay. And you could see basically the two of these track each other over these years up until mid-90s. Basically the same. Then something happens. Right at around, these mid-late 90s when we had the tech boom and all that euphoria, ever since that moment, everything's been out of whack. Stocks have gone considerably higher than disposable personal income. I also want to note the fact that you see this. If I change my color here, maybe you'll be able to see it a little better. That if you look, what happens? It sort of almost goes back into these levels. Actually, in this case, it does. In this case, it goes beyond it. And then it returns higher. So if we were to see that, based on where we are today, the red line is the Wilshire 5000. It doesn't matter ultimately where we go to. Okay? Maybe the stocks are going to reach, considerably higher numbers. It's possible. But it has to then come down in such a significant drop. I mean, this would be truly historic. It's going to be amazing to watch. It's not going to be a good thing, but we'll be amazed, and I'm saying it in that way. Okay, again, same thing, just zoomed in from the financial crisis up until today. We're going to see something, it's going to be unbelievable, but we would have known about it previously. It's just a matter of when. All right. Now this right here, essentially, as soon as the monetization stops, ultimately, it's not going to go well, because the market has been relying on that quantitative easing, the low interest rates. If we start seeing interest rates creeping up slowly, we will then have to look at the QE. Is that going to pick up? No. If that's continuing to decline, even if it's a small amount, ultimately stocks are going to go down with it. That's just a fact. And then right here, wanted to drop this in at the very end. The IMF put out a report. I just covered it recently. Wanted to touch on another point, saying the fact that they look good in the short term. Everything's great. Nothing's going to be a problem. Don't worry about it. Longer term, we have lots of risk. That's what they said in the report. Just wanted to bring it to you. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it supports the channel. I need it more now than ever because of what's happening. Last but not least, if you found this video informative, please take a look at my books. They're in the links below. Definitely check out all the links that you see down there. There's some that people keep asking me about. They're in the description. Just take a look for yourself. You can actually go to Amazon, flip through the pages of these books for yourself to see if you like them. Take care.